Global commodity markets are currently operating under a state of structural pressure driven by high-stakes geopolitical developments. Under normal conditions, domestic economic data, like employment or manufacturing reports, serves as the primary engine for weekly equity trading. We are seeing a correlation breakdown. As U.S. oil and the VIX rise, the S&P 500 diverges sharply in the opposite direction. The link between crude and volatility has tightened, making oil the primary risk indicator. The market prioritizes macro risk over corporate fundamentals. In this risk-sensitive environment, broad indices are reacting to geopolitical shifts, rendering standard technical assumptions for price action temporarily obsolete. Navigating calendar week 14 requires a clear analytical baseline, the 70-30 hierarchy of market drivers. 70% of current price action is dictated by the geopolitical risk premium currently inflating the cost of energy. The remaining 30% is tied to domestic labor and economic data, which now functions as a secondary confirmation signal. This creates a transmission cascade. Risk originates in geopolitics, flows through commodities like the USO, impacts broad volatility, and eventually prices into specific sector equities. To understand the week ahead, we must map exactly how this oil-driven risk transmits down the cascade to dictate retail equity pricing. At the top of the transmission cascade, the geopolitical catalyst remains the absolute origin point of current market stress. While crude prices represent a commodity cost, they currently serve as the primary catalyst for VIX expansion. As the VIX expands, it exerts broad downward pressure on the market index layer, regardless of individual stock performance. This environment sets the stage for Monday's key catalyst, Fed Chair Jerome Powell's 10:30 a.m. address. Markets are looking for specific shifts in his tone regarding the persistence of inflation and potential policy adjustments. The Fed's dual mandate is directly impacted by rising oil prices, creating a feedback loop between energy costs and central bank interest rate policy. Monday's address will establish the week's baseline volatility by confirming how the Fed plans to address these commodity-driven inflation risks. On Tuesday, the focus moves down the cascade to domestic data points that track the health of the consumer. The JOLTS job openings report is expected to show roughly 6.9 million vacancies. A reading below this level suggests a cooling in labor demand, signaling a shift in the strength of the jobs market. Tuesday's most critical metric, however, is the consumer confidence report. The market watches the 88 level as a historical baseline for consumer sentiment. Dropping below 88 signals a contractionary transition, forcing a re-rating of retail and consumer discretionary stocks based on lower future spending. Conversely, holding above 88 offers a stabilization bounce for these domestic sectors. This 88 threshold is where abstract macro pressure is converted into tangible sell-side pressure within domestic retail equities. Wednesday represents the week's heaviest cluster of raw economic data. The ADP employment change report is projected to show only 42,000 new jobs. This projection is a sharp drop from the previous reading of 63,000, indicating a deceleration in private sector hiring. A print that misses this 42,000 target would act as a negative surprise, confirming the labor market's cooling trend. We also see the release of the ISM Manufacturing Index and broader PMI data. These manufacturing metrics combine with the labor data to paint a complete picture of business activity and economic resilience. Wednesday's data serves as a stress test, determining if the domestic economy is strong enough to withstand the macro pressures established earlier in the week. On Thursday, we analyze the final component of the 30% microdriver framework, initial jobless claims. The expectation for this report is 212,000 new claims. A print higher than 212,000 would suggest an acceleration in corporate layoffs, further weighing on market sentiment. If claims stay below this ceiling, it provides a short-term signal of labor stability. However, this data must be viewed through the lens of the 70% macro driver, the cost of energy. Even stable labor data can only provide a temporary buffer if oil prices continue their upward trend. Thursday's data can confirm short-term momentum, but it lacks the structural weight required to override a macro commodity trend. The temporal structure of calendar week 14 is defined by the market closure on Good Friday. This leads to a phenomenon known as compressed volatility. A shortened week forces 5 days of institutional trading volume into 4, which typically amplifies the scale of price swings. In this environment, we should expect rapid corrective bounces and intraday swings of 1 to 2% in either direction. This compression makes the market hyper-reactive to the 30% microdata, creating high-frequency noise within the broader macro trend. By reviewing the full transmission cascade, we can see how macro risk is currently dictating micro equity prices. We are tracking JOLTS at 6.9 million, ADP at 42,000, and jobless claims at 212,000 as the key data pivots. Any upward movement in the broad index this week is likely a technical corrective bounce rather than a change in the primary trend. A sustained trend reversal lacks the necessary fundamental support, while the geopolitical risk premium remains unresolved and the VIX is elevated. Domestic economic data will determine the market's velocity, but the geopolitical premium on oil ultimately dictates its destination.